What if I told you there was a time when kings, those all-powerful monarchs, supposedly crowned by God, ruling armies, and issuing edicts, were actually less powerful than the bankers who loaned them money? Imagine a world where monarchs owed their very thrones to financiers, and the so-called royal treasuries were nothing more than special accounts in private banking houses. It sounds like something out of a fantasy novel, right? But it's all true. For centuries, while kings and queens were parading in their finery, banks were quietly amassing a different kind of power, the power over money, over trade, and even over war. In many ways, they became the real rulers, pulling the strings from behind the scenes. This isn't just a story about numbers. It's a story about a massive shift in power that defines the world we live in today. So let's start our journey back in medieval Europe. In those days, if you needed money, you didn't go to a bank as we know it. The church had strong rules against charging interest, or usury, calling it a sin. This created a gap. Kings needed cash for wars, merchants needed capital for trade, but the traditional systems weren't cutting it. Who stepped in? Often, it was Jewish moneylenders and groups like the Knights Templar. The Templars were particularly fascinating. They were a military order of crusading knights, but they built one of the earliest and most sophisticated banking networks across Europe and the Holy Land. Pilgrim could deposit money in London and receive a letter of credit to withdraw it in Jerusalem. This was revolutionary. It was safe, it was efficient, and it made them incredibly wealthy and influential. They became bankers to popes and kings, financing everything from royal lifestyles to entire military campaigns. Their power grew so immense that they eventually became a threat to the very monarchs they served, leading to their dramatic downfall in the early 14th century. But they had proven a crucial point. Controlling the flow of money was a source of immense power. As we move into the Renaissance, the center of finance shifts to Italy, specifically to cities like Florence. This is where we meet the legendary Medici family. They weren't just patrons of the arts. They were master bankers who perfected the system. Starting as wool merchants, they built a banking empire with branches all across Europe. They invented or refined key accounting practices like double-entry bookkeeping, which allowed them to track credits and debits with incredible precision. The Medici Bank became the official bank for the Pope, a position that gave them enormous prestige and profits. They loaned money to everyone who mattered: dukes, princes, and kings. Their influence became so great that they essentially ruled Florence. They didn't need an army to sit on a throne. Their power came from their ledgers. When a rival family, the Pazzi, tried to overthrow them, the plot failed. Not just because of popular support for the Medici, but because their financial network was too deeply embedded in the city's lifeblood. The Medici story shows us that a bank could be more than just a business. It could be a dynasty, a political machine that could make or break fortunes in governments. By the 17th and 18th centuries, the scale of banking exploded. Wars were becoming more frequent and expensive, and nations needed a way to fund them on a scale private families couldn't handle. This led to the birth of the National Bank. The Bank of Amsterdam, founded in 1609, became the financial hub of the world, stabilizing the currency and financing the Dutch Republic's golden age of trade. Then came the Bank of England in 1694. It was created specifically to fund England's war against France. The government borrowed a huge sum from a group of wealthy investors, and in return, those investors were given the right to form a bank that could issue banknotes paper. Money backed by the government has promised to pay. This was a game changer. It created a permanent national debt, but it also gave the government access to almost unlimited funds. The Bank of England's ability to raise money allowed Britain to build the world's most powerful navy and forge a global empire. The crown was still the symbol of power, but the bank was its engine. This brings us to the modern era and the rise of central banks, like the Federal Reserve in the United States. These institutions now control national monetary policy, setting interest rates, managing inflation, and acting as a lender of last resort. Their decisions affect the value of our savings, the cost of our mortgages, and the health of the entire economy. The power once held by the Medici or the Bank of England is now concentrated in these modern institutions. So, from medieval moneylenders to the digital transactions of today, the story is consistent. While crowns and flags capture our attention, the real power has often been held by those who control the credit, the debt, and the trust that underpins our world. The biggest battles in history weren't always fought with swords and cannons. Many were won and lost in the quiet accounting rooms of banks, with interest rates and debt ledgers as the weapons of choice. The world wasn't just shaped by kings and generals. It was built by bankers. Let's travel back to medieval Europe, a time with little hard cash and a lot of risk. Imagine you're a merchant. Trade is slow and carrying coins is dangerous. How do you do business? This is where the first bankers stepped in. They weren't in shiny buildings. They operated from private homes, offering credit and changing foreign coins. But there was a catch. The church condemned charging interest, calling it usury. So these early financiers got creative, using complex instruments like bills of exchange and letters of credit. It wasn't about the money you held, but the trust that you would pay it back. This trust, this asterisk credit asterisk, became a powerful new currency. Institutions like the Grand Tavola in Siena, founded in 1255, became so trusted they even managed the Pope's income. And by 1407, the Bank of St. George in Genoa was born, often called one of the first modern public banks. These banking houses weren't just businesses. They were empires of trust, with networks stretching far beyond the reach of any single king. Now, what happens when these financial empires meet royal ambition? Welcome to the high-stakes game of lending to kings. In the 14th century, the Bardi and Peruzzi families of Florence were the titans of European banking. They bankrolled monarchs, most notably King Edward III of England, for his wars. The reward was immense, but so was the risk. In 1345, Edward defaulted on his massive loans, refusing to repay nearly 1.5 million gold florins. The result? Both banks collapsed, sending shockwaves across Europe. This was a brutal lesson. A king who won't pay is untouchable. There's no court you can take him to. From that point on, banking families like the Medici in Italy and the Fuggers in Germany learned to play a different game. They didn't just lend money. They underwrote ambition, financed wars, and backed political factions, blurring the line between financier and political player. They diversified into mining and trade, making themselves indispensable. Their power wasn't just in their gold, but in their ability to pull the strings of kings. As kingdoms grew into modern states, monarchs needed a constant, reliable flow of cash for standing armies and overseas empires. Private bankers, no matter how rich, could only do so much. This led to a game-changing innovation, the national bank. After England's glorious revolution, Parliament gained control over spending, and in 1694, the Bank of England was founded. Its job was to fund the state's wars by managing public debt. For the first time, the state itself became a borrower, and bankers controlled the terms. Government bonds, interest rates, and the ability to print money became the new levers of power, arguably more crucial than armies. This new system was powerful, but fragile. A credit crisis in 1772 showed just how quickly a single bank's failure could spread panic through the entire economy. This created a new tension that defines our world even today. Should banks control states, or should states control banks? The dance between finance and power that began in medieval market stalls continues to shape our governments, our economies, and our lives. Is it the person wearing the crown, or the one signing the checks? Let's explore how finance has shaped history and why banks sometimes outlast entire kingdoms. Now let us zoom out and see the deeper pattern. Credit and debt are tools of power. When a bank lends money to a state, it doesn't just expect to be paid back. It expects repayment with interest. That interest represents a claim on the government's future income, its tax revenues, its resources, its very destiny. Over time, as debts accumulate, the lenders gain a powerful say in the state's future. A new monarch might take the throne, but the old debts remain, constraining their choices and limiting their power. This isn't just ancient history. In the 19th and early 20th centuries, this dynamic played out on a global scale. Powerful lenders in Britain, France, and Germany extended massive loans to weaker states across Latin America, the Ottoman Empire, and various colonies in Africa. When these states struggled to repay their debts, the lenders didn't just send polite reminders. They pressured their own governments to intervene, imposed harsh structural reforms on the debtor nations, and in some extreme cases, even backed political interventions. Debt became a powerful tool of neo-colonial control, a way to exert influence without the need for a formal empire. Back in Europe, a new kind of institution was solidifying its power, the central bank. These weren't just commercial banks. They became pillars of the state itself. They set monetary policy, worked to control inflation, and acted as the lender of last resort during crises. The regulations they created, or the lack thereof, determined who could get credit, how much it would cost, and ultimately, who could build the industries and infrastructure that define the modern world. Think about it. Bankers and central bankers influence the value of your currency, the interest rates you pay on a loan, and even the overall perception of economic risk and confidence. That is immense power, arguably more enduring and far-reaching than a king's decree. You might have heard the term bankocracy, the idea that financial institutions, not democratically elected governments or hereditary monarchs, are the ones really running the show. In some critical views, the world of banking is seen as a de facto government, a government of capital. This isn't a new concern. Thomas Jefferson once famously warned that banking institutions were more dangerous than standing armies. He foresaw a future where a financial oligarchy could overshadow political liberty and the will of the people. Of course, the story doesn't end there. The immense power of banks didn't go unchallenged. Throughout history, we've seen waves of financial crises, populist backlash, and political movements demanding reform. The Great Depression was a monumental turning point. The widespread bank failures and economic devastation forced governments to act. This led to a new era of regulation, creating central banking mandates to protect the public good, establishing deposit insurance to secure people's savings, and implementing financial oversight to prevent reckless behavior. In many countries, the state reasserted its control over monetary policy and the financial system, but the balance of power wasn't reset completely. Banks have proven to be incredibly resilient. They often retain significant informal power through sophisticated lobbying efforts, constant financial innovation that outpaced regulators, and the growth of shadow banking systems that operate outside traditional oversight. Fast forward to our modern era, and you'll see that central banks wield incredible influence. They control the money supply, set the interest rates that affect everything from mortgages to business loans, and even intervene in sovereign debt markets to stabilize entire countries. The line between the state and the bank can become incredibly blurry. Just think back to the 2008 financial crisis. Who bailed out whom? It was governments that stepped in to save the too-big-to-fail banks, effectively making the state dependent on the financial sector for its own stability. So while kings and queens may have formally ceded their power centuries ago, the financial sector now holds a kind of latent sovereignty. It has power over economies, credit flows, government bailouts, and ultimately, determines which grand projects and ideas get the funding to become a reality. So this brings us to a crucial question. Why do banks so often outlast kings, regimes, and even entire empires? There are a few key reasons. First is the idea of continuity versus change. Banks are institutions built on legal charters, long-term contracts, and cross-border networks. A political regime can be overthrown in a revolution, a king can be deposed, but the intricate machinery of banking, the loans, the contracts, the credit networks tends to persist. It's a system designed for continuity. Second, there's the network effect. Banks sit at the very center of the economic web, connecting governments, corporations, and individual households. They are the nexus through which capital flows. When the political system shifts, banks are often nimble enough to adapt to the new reality. Monarchs and regimes, on the other hand, can be brittle and may fall when the political winds change. Third is the nature of their power. The power of the purse is what we call soft power. It's less visible than an army or a crown, but it's far more pervasive. Debt obligations, bond market ratings, and credit scores shape the behavior of entire nations, often more effectively than any direct command. Even in modern democracies, the judgment of the financial markets can force a government to change its policies. Fourth, there's often a lack of viable alternatives. In most economies, there is no other functioning infrastructure that can replace the role of banking. States rely on them to manage their finances, businesses rely on them for investment, and citizens rely on them for daily transactions. This reliance gives them an entrenched position. Finally, their influence is often opaque and operates behind the scenes. It's exercised through complex regulations, high-level appointments, discreet lobbying, and the ingrained culture of central banking. It's not the kind of power that's paraded in the streets. So, as we've seen at many pivotal moments in history, the real power wasn't found in wearing a crown, but in controlling the flow of credit. Have you ever wondered who really holds the power? Is it the president, the prime minister, the one with the army and the laws, or is it someone else, operating behind the scenes? For centuries, we've been told that power comes from the sword, from the crown, from the ballot box. But what if I told you the true story of power is written not in law books but in ledgers? That the most significant shift in human history wasn't on the battlefield, but on a banker's balance sheet? Today, we're pulling back the curtain on a story that's been hiding in plain sight for 1,000 years. The secret history of how banks became more powerful than kings. This isn't just a history lesson. It's the hidden blueprint of the world we live in right now. Let's rewind the clock. In the medieval world, a king's power seemed absolute. He had the divine right, the loyal knights, the towering castles. But he had a weakness, a constant, nagging problem. He was always short on cash. Wars, palaces, and a lavish court don't pay for themselves. So where did a king go when the royal treasury was empty? He couldn't just print more gold coins. He had to go, hat in hand, to a new and rising class of people, the moneylenders. At first, these were just small-time merchants, sitting on benches or banks in Italian, where we get the word bank, exchanging currencies. They were seen as necessary but often despised. Charging interest or usury was even considered a sin. But necessity, as they say, is the mother of invention. And kings were very, very needy. This is where our story takes its first dramatic turn. We see the rise of the great Italian banking families like the Medici in Florence or the Bardi and Peruzzi. They weren't just changing coins anymore. They were financing wars, funding crusades, and bankrolling royalty across Europe. They became the silent partners to thrones. Think about this. A king wants to invade a neighboring territory. He needs to hire mercenaries, forge weapons, and supply his army. The Bardi family steps in and says, "Of course, Your Majesty. We'll provide the funds." Suddenly, the banker isn't just a lender. He's a stakeholder in the war itself. The king's victory is the bank's return on investment. This created a fragile, dangerous dance. The king had the military power, but the banker had the financial power. One couldn't succeed without the other. But what happens when a king can't pay his debts? This is where the power dynamic gets truly explosive. Imagine a king who couldn't raise an army because his banker refused to lend. It happened. King Edward III of England, deep in debt from the 100 Years' War with France, simply defaulted on his massive loans from the Bardi and Peruzzi banking houses in the 1340s. He just decided not to pay. The result? These two banking giants, the cornerstones of European finance, collapsed. It was a financial apocalypse. The crash sent shockwaves across the continent, wiping out fortunes and plunging Florence into a depression. The message was clear: lending to a sovereign was the ultimate high-risk, high-reward game. A king could make you unimaginably wealthy, or he could destroy you with the stroke of a pen. So the bankers had to get smarter. They had to find a way to control the kings. How do you control someone who is supposedly above the law? You change the rules of the game. Instead of just lending money, bankers started demanding collateral. Not just a jewel or a castle, but something far more valuable: control over the king's revenue. They would say, "Your Majesty, we will give you this loan, but in return, we will take control of your tax collection in this region. Or we get the rights to your silver mines." Suddenly, the bankers weren't just lenders. They were becoming embedded in the state itself. They were managing the king's income streams, influencing his economic policies, and ensuring they got paid first. A monarch who defaulted might destroy a single banking house, but in doing so, he reshaped the politics of Europe by forcing financiers to build systems that were king-proof. The balance of power was slowly but surely tipping. The next great leap was the invention of the central bank. The Bank of England, founded in 1694, was a game-changer. It wasn't just a private bank. It was a public-private partnership created for one primary reason: to finance the English state's wars against France. The government needed money, and a group of wealthy investors agreed to provide it. In return, their bank was given a special monopoly, the right to issue banknotes, essentially government-backed paper money. Think about that for a second. The power to create money was being handed over from the crown to a private institution. This is the moment where the line between the state and finance begins to blur completely. A central bank whose decision on interest could tip elections, not just economies, was born. This model was so successful, it was copied around the world, creating the financial architecture we still live with today. Now, let's connect this to our world. Does any of this sound familiar? When you hear about sovereign debt crises in countries like Greece or Argentina, what's really happening? Lenders now, massive institutions like the IMF or private bondholders are telling elected governments what to do. They impose conditionality, demanding cuts to public spending, changes in laws, and privatization of state assets in exchange for bailout loans. Think of a king as the CEO of a country. For centuries, he was the only one in charge. But now, the bankers are like the shareholders and the board of directors. They're the ones who can often fire the CEO or dictate the company's direction. The modern culture of bailouts, the concept of an entity being too big to fail, directly echoes these old royal debt crises. We're still playing the same game, only the names and the scale have changed. So, what do we take away from this long, twisting journey? We've seen how banking evolved from dusty money-changing tables to the powerhouses behind nations. We've watched as monarchs, once thought to be unchallengeable, became mere borrowers, beholden to their financiers. We've uncovered how debt, interest, and credit became the unseen levers of global control. The key shift is this: sovereignty moved from the sword to the ledger. Kings could conquer lands with armies, but bankers could conquer entire kingdoms with capital, credit, and contracts, all without firing a single shot. Yet it's not a simple tale of domination. The relationship has always been symbiotic and always fraught with tension. States needed capital to grow and defend themselves. Banks needed the state's legitimacy and protection to enforce their contracts. Crises, defaults, and revolutions have repeatedly recalibrated this delicate balance of power. The legacy of this dance lives on all around us. When a central bank like the Federal Reserve adjusts interest rates, it's not just an economic decision. It's a political act that can influence who wins the next election. The power of money is often hidden in plain sight, in the jargon of bond markets, in the fine print of debt structures, and in the backroom deals that shape our world. Financial firms lobby governments, influence regulations, and steer the flow of capitalism in ways most of us never see. So next time you hear about a central bank decision, or a government struggling with its debt, or another massive corporate bailout, remember this story. This isn't just economics. This is history repeating itself. It's a centuries-old story of power, control, and the institutions that quietly rule our world. Which brings us to a final crucial question. What does real sovereignty even mean today, if money and credit hold such powerful sway over rulers, governments, and all of us? Are we truly governed by the visible arms of government, or by the invisible circuits of global finance? If you enjoyed this deep dive into the hidden forces that shape our world, make sure you hit that subscribe button and give this video a like. And I want to hear from you in the comments. Which moment in this story shocked you the most? When the banks first outshone the kings, or when you realized how modern finance has quietly taken their place? Thanks for watching, and until next time, stay curious.